Well, good afternoon and welcome to HYROX's weekly webinar where we're going to talk about what we see happening in the global economy, in financial markets and the world of wealth management, and how all of this impacts our decisions on the best courses of action for our and your investment strategies. Now, we invest our money in the exact same models as our clients, and we think that this defines the true nature of our prudent and disciplined investing strategy. Our discretionary management enables us to make quick decisions and execute them immediately for all of our clients simultaneously, which is especially important in volatile markets as we take advantage of opportunities that avail themselves to us. I'm Scott Tomlinson, and my partner and colleague Paul Tepsich, the founder of HYROX, is also with us, as is our financial planner and wealth forecast specialist, Bianca Tomlinson. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the Private Client Division tab. Excuse me. Let's start with a quick review of our themes for 2017. But we think that our strategy of having a tactical perspective to investing becomes even more important in 2017 because of the even greater levels of uncertainty imposed on us by a number of developing factors. If the new U.S. administration is able to push forward some of its tax proposals and spending initiatives, there is a greater likelihood of inflation, and the expectations surrounding this will change the dynamic in financial markets. Now, to a large degree, bond markets have been showing us this already. Higher bond yields and higher short-term rates in the U.S. with 2 or 3 more Fed rate increases will increase the cost of borrowing, which in turn could prevent us with a whole new set of risks with global debt levels at record highs. And with improving economic conditions and a lower tax burden, it is expected that earnings will grow at an approximate rate of about 11.5% in 2017. However, this appears to be more than priced into current equity markets at this particular moment. And it remains to be seen how the new populist revolution will play itself out. But first, Brexit, then the new President Trump, and Italy's referendum and upcoming elections in the Netherlands, France, and Germany. There are very real potential problems for the euro, and as well, the U.S. protectionist agenda will provide a boatload of uncertainty as trade deals are canceled and or they are renegotiated. Well, why more emphasis on a tactical approach? Well, the old rules for balance and diversification are no longer working in their traditional manner, and long-held relationships between asset classes have been breaking down. And this was an important part of the development of a tactical investing model to complement our fixed income and global equity models. The 3 models that we use to get balance in our portfolios allow us to have greater flexibility and depth over the standard buy and hold strategies. And this will be even more important as we structure our investing for 2017. Well, speaking of buy and hold strategies, as we look at the benchmark All Country World Index total returns, if you had been somewhat more in cash because of a more tactical approach to investing at the beginning of 2016, as we were, you would have had a great buying opportunity at the beginning of the year. However, if you had a buy and hold portfolio, you would have been fully invested at that point in time, watching your portfolio sink a lot in January before rebounding to be only up by about 3.87 over the course of the 2 years. That would be annualized over the 2-year period. Well, to get the full benefit of that 19.25% return over last year, you would have had to start the year with 100% cash and got yourself invested by the 3rd week in January. Now, the 3-year total return was 5.32, and the 5-year total return 8.86. Now, just as a reminder, the All Country World Index is weighted heavily toward the U.S., with about 51.5% of the All Country World Index dedicated to U.S. companies. Now, if you had a fully invested 60% equity portfolio, your exposure would be about 31%. A 40% equity portfolio would have about 20%. Now, each country is represented to a smaller degree. Don't forget that it is the companies domiciled in those countries that are the underlying investments. As for the other portion of a balanced portfolio, the Canadian Bond Index ETF, the one-year return was 162, the two-year return less than 1%, the three-year return about 367, and the five-year return has been about a little over 3%. When we combine the two benchmarks into a more growth-oriented 60% equity and 40% fixed income portfolio and allow for fees and costs, the one-year total return was 1116. But remember, you would have had to start with 100% cash and be fully invested on January 22nd of 2016. Now, if you're already fully invested, over the two-year period, your annualized average total return over those 2 years would have been just 191. There is the argument for a more flexible and tactical portfolio. 3 years, 3.5%, and 5 years, 539. And for a less growth-oriented 40% equity and 60% fixed income portfolio, the one-year return is 7.5. 1 year, 2 years, just a little under 1%. 3 years, about 3, a little over 3%, and 5 years, about 4.25%. A High Rock client portfolio, already invested but with a higher weighting of cash for the purposes of finding new opportunities over the last year, has had a total return of almost 9% after fees and costs, which is below the benchmark of 1116, as I showed before. But the longer-term portfolio from October of 2012 continues to have an advantage over the buy and hold strategy with a benchmark of about 5.25%. So we tend to put significantly more emphasis on the longer-term performance rather than the quarterly and one-year performance, as it smooths out the averages over longer periods of time. But in order to make proper comparisons, we also have to look at the risk factors, or the return per unit of risk taken, which basically helps compare apples to apples. If we look at the 2-year period for the High Rock client portfolio, the return for per unit of risk taken is 2.46 times. The benchmark 60% equity, 40% fixed income buy and hold portfolio is only 0.84 times. Now you can see the S&P 500 and the TSX have lower return risk relationships, and on the chart this translates into a significantly better return for the amount of risk taken for the High Rock client relative to the benchmark buy and hold strategy. So in a nutshell, the tactical experience has been significantly better, and this is what we're talking about when we talk about being tactical, having more cash at times to take advantage of opportunities. Well, as the Trump initiatives unfold, it is expected, as I said before, that costs and wages will rise, adding inflationary pressures that will drive the U.S. Federal Reserve to push short-term rates higher. Now, while we are still quite a long way from seeing the flattening of the yield curve, it is important to remember that when the short and long-term rates narrow and the yield curve flattens, recessions follow shortly after, and we'll keep an eye on this over time. Investors have grown more confident because clearly stock markets have built in a robust 2017, even with earnings already estimated to grow at about 11.5% next year. The 12-month forward-looking price-to-earnings ratio is at its highs near about 17 times and well above the 10-year average of 14.4 times. Another of our metrics of value also shows stocks to be expensive. However, it does not mean that they might not get more expensive in the not-too-distant future. But we shall continue to be looking for value when we do make purchases. Well, there's plenty of action on the geopolitical front this week. From the inauguration speech, President Trump stated that every decision on trade, on taxes, on immigration, on foreign affairs will be made to benefit American workers and American families. and that we must protect our borders from the ravages of other countries making our products, stealing our companies, and destroying our jobs. Protection will lead to great prosperity and strength. But, as history has proven, isolationism does not necessarily work. So, it was a busy start to the president's first week. He met with business leaders promising a border tax for those who outsourced. He approved pipeline completion and withdrew from the Trans-Pacific Partnership trade deal, among other things. It is expected that President Trump will want to renegotiate NAFTA and will meet with Prime Minister Trudeau soon. Ambassador to the U.S., David McNaughton, does not think that Canada is the main focus of the renegotiation of NAFTA. We shall see how that all unfolds as well. Well, speaking of trade deficits, Trump has pledged to use every lawful presidential power to remedy trade disputes with China, including tariffs. And after the presidential inauguration on January the 20th, the Global Times, a Chinese newspaper run by the Communist Party, said Trump's speech signaled a high possibility of trade frictions. Overall, U.S. equities have more to lose than their Chinese counterparts in a trade war. While almost 10% of companies in the MSCI U.S. index derive at least a tenth of their sales from China, less than 2% of firms in China can say the same about the U.S., according to Morgan Stanley. Well, keeping in mind the International Monetary Fund's latest analysis, it has raised its forecast for U.S. growth based on the Trump agenda, but has warned that if protectionist trade proposals set off a trade war, it could be quite destructive for the global economy. So we have to stay tuned to see how that will unfold as well. In the UK, Brexit will require a parliamentary vote, but it may only hold it off a little longer because it is clear that in all likelihood, with most legislators on side, it will pass. So here at High Rock, we will continue to monitor event risk and price valuation, and we will add or reduce holdings in our models as opportunity presents itself, and by preparing our strategies with continued deep levels of research as we did last year, keeping in mind that our tactical approach allows us to add value and reduce risk to give us the best possible risk-adjusted returns. Paul, any commentary this week?
Yeah, sure. Thanks, Scott. I guess just one overall sort of larger, bigger picture macro comment I would have, and I wrote about it a bit in the blog today, probably more relevant yesterday because it kind of reversed today, but we found it interesting that yesterday seemed to be, well, Trump's first day in office, but it was, I would say, a very pro-business day for the administration. What I thought was very good for the market, good for stocks and bad for bonds, and it ended up being the exact opposite. So that kind of left me with the feeling that perhaps this stock market in the U.S. is a little toppy here, and I wrote in the blog today that the NYSE, New York Stock Exchange, short interest, so all the sort of hedge fund, fast money guys out there, shorts have been taken down substantially over the past number of months, which is a sign that perhaps there's not a lot more buying to come into the marketplace, or it certainly removes one of the buyers. And the opposite in the bond market, the government bond market. In fact, it has a record number of shorts, all-time record. And maybe that's why yesterday we saw the opposite of what we thought would happen. So regardless, I still think that stocks are a little toppy here. I think the Dow will have a hard time getting through 20,000. I know that's probably a big psychological number, but I just actually read something, Scott, it's kind of interesting. This is the lowest one-month trading range in the Dow since 1900, so 117 years. January is the lowest trading volatility. And you didn't put it up today, maybe next week we will, but the VIX, which you show often, has obviously been hammered down, and I guess our view at High Rock is when volatility gets crushed like that and is so low that it really only has one way to go, and it means an elastic band can only stretch so far, and then something has to give. So we will wait and be a little more patient. And sorry, sorry, on a micro basis as well, I've got an energy name that I know reasonably well. The bond is expensive. I'm not going to add that, but I've made up my mind we'll add some of the equity, the stock, tomorrow if we're able to at an okay price. And I'm doing some work on an old name that I haven't had in any portfolio, whether it's a Scotiabank portfolios or our private client portfolios for quite a number of years, or well, probably 2 years. But I'm actually looking at the equity. I think it might be kind of cheap for us, so we might add that as well. And still looking to add a couple others that we've just kind of dipped 1 foot in the water, and I want to get more. But I'm trying to be patient and get cute here because I think the market could trade off just a little bit. That's it. I think I might have talked longer than you did. Sorry.
Well, that's good. I'm glad that you're participating because I'm sure everybody's interested to hear what you have to say too. So, thank you for that. Well, that's it. But as always, we want to thank you for taking the time out of your busy schedules to tune in. If you have any questions or concerns, please certainly feel free to email them to us. We will be back with our next update next Tuesday. But until then, this is Scott Tomlinson on behalf of my colleagues Paul and Bianca. We want to wish you all a great week.